Happy Friday. Hey, everybody. This is Craig Modelmog of Cornerstone Wealth Management, and welcome to this week's episode of Wall Street X's and O's. Yes, I have to confess, last week I did not do this. I've kind of tried to switch to every other week because I'm really focused on content. I really wanted this to be worth your time. I don't want people to get sick of tuning in. I think that's what happens, which I don't blame you, actually. So I'm trying to really focus on really good quality information. Last week, I kind of overdid it, and I got to Friday and I was dead. So my apologies for those of you who are tuning in the first time. This show is uncut and unedited. I'm going to throw out my disclaimer here. The information contained herein is not an offer or to sell or a solicitation to buy any security, investment vehicle. Does not constitute investment recommendation, legal, tax advice, accounting, or any other investment advice. Investments can and will lose money, and they're not FDIC insured. But anyway, for those of you who know, still dealing with a little COVID long haul deal, which is a joy, the chronic fatigue thing. And there's just time where you just feel like crap and you don't want to do anything. So, you know what? It's getting better, but I still have days when I feel good and you overdo it and I pay for it. You know, it's like a runner who really feels good after a long, tough workout the day before. So you go out and you hit it again and you're dead. So anyway, but it's all good. So anyway, I've got a really good show today. We've got some good things. We're going to talk about the bond market and what it's saying, which I don't know, but we're going to focus on a few things that it's saying and kind of my thoughts there. We're going to do an unemployment update because obviously that's a big deal. The labor economy, as we know, is really front and centered, and we are seeing some subtle improvements, although I don't think it's coming online quite as quickly as anticipated. And then we're going to talk about inflation. Is it transitory, meaning temporary? Or is it going to be stickier? I'm more in favor of the caramel version, which is stickier. I love caramel, by the way. Love caramel. But let's kick this thing off. Bond market. What's it telling us? Here's some interesting things. First of all, let's look at some year-to-date numbers and performance. Long-term Treasury minus 7.9. Treasuries in general, just overall Treasury index minus 2.5. Short-term governments down 2.51. Government credit minus 1.96. Barclays Ag is minus 1.6. High-quality corporates are down 1.27%. You got mortgage-backed securities down 0.77. T-bills are flat. Asset-backed securities or bonds are flat. Municipals are up 1%, and high yield, which is junk bonds, are up 3.62. Interesting, very interesting. If you look at today, 10-year Treasury is yielding 1.28%, which if you look at inflation, which is north of 2 now, that means if you own a 10-year Treasury net of inflation, you're losing money. In fact, if you own a 30-year Treasury, which the 30-year Treasury today is paying 1.92%, wave your flags. That's 1.92% for 30 years. That's like, here, U.S. government, I trust you to use my money wisely, and in return, I'm going to receive 1.92%. That's a joke. That is a big joke. And think about this. At the end of the first quarter is around 2.4. So we've seen yields come down 20%. That's a big number. It's a big number, people. And we need yields to rise. We really do. We've been in this low interest rate environment for so long. I was talking to a good buddy of mine, Scotty. Scotty, if you're tuning in, peace out. Enjoy Maine and the lakes in Maine. Always good to talk to you, man. I've known Scotty Whitehouse for a long time, and he's just a good friend. But anyway, we were talking about yields and how because yields are so low and have been so low for so long, it puts an inordinate amount of pressure on your equity part of your portfolio. Because as an investor, you can't be 100% stocks. unless you're young and you can handle volatility, then I would even argue there are times when, regardless of age or how aggressive you are, you should still not be 100% stocks. You just shouldn't. So it puts a lot of pressure on our equity portfolios to really add alpha or add performance, and that's hard to do consistently. In fact, you can't do it consistently. Nobody can do it. Nobody can do it. So we really need rates to rise. Here's some problems I see. Rich Bernstein of Rich Bernstein Advisors. Rich was one of the main guys at Merrill when I was at Merrill. Rich is a stud. He, David Rosenberg, all these great people back before Bank of America bought Merrill, was fantastic. Now Merrill, I'm not even going to go there because I'll get angry and I'll probably start cussing and get myself in trouble. But Rich Bernstein was talking, and this is being sourced from the New York Federal Reserve. When you look at ownership of the Treasury market, the first thing comes to mind is what? Most people say China. You're wrong. You know who the number one owner of U.S. government debt is? The U.S. I know, hard to believe. And if you look at different tranches, you look at 0 to 1 year, 1 to 2, 2 to 5, 5 to 7, 7 to 10, 10 to 20 year, and then 20 to 30 year Treasury bonds. On average, the U.S. is owning about 30% of all issued bonds. And if you look at the 10 to 20 year tranche specifically, the United States owns 54% of all 10 to 20 year treasuries that have been issued. Here's the problem. Let's take a step back in history. If you go back to the 70s, have you ever heard of some boys, I'm going to call them ornery boys, called the Hunt brothers? For those of you that don't know who the Hunt brothers are, go Google them, pull up. They tried to corner the silver market back in the 70s. Let's just say it didn't end well. The problem is when you corner a market, who do you have to sell to? Okay? The United States government right now is in that situation. They have cornered a market. The Hunt brothers had owned approximately between 30 and 35%, and that's arbitrary, but it's in that ballpark. The United States government is right there on all treasuries that are issued. Okay? Case in point, headline last week, this is July 13th. This was in Barron's, and you can find it in a lot of newspapers around the country. It says the U.S. had a weak 30-year auction because the long-dated bonds looked pricey. My argument is this. If you look at the most inflated part of our market right now, do you know what it is? It is not the stock market. Although there are parts of the market that are very frothy and pretty stupid right now. But I would argue that the bond market overall as an asset category is the most inflated part of our economy right now. And this is going to be interesting to see how this plays out. You got the U.S. government buying $80 billion a month, and they've been doing this throughout COVID, throughout the pandemic. Okay, as that stops, because they can't do it forever, unless you're Japan. I know that was a bad one, but I was stretching for that, is reaching, and I threw Japan under the bus. Okay, Japan's dead. Japan is a zombie. They should make a Netflix original called Japan, March of the Zombie Economies, because that's what Japan is, and that's been happening for 40 damn years. Okay, so the U.S. cannot keep buying bonds. The kicker is once they start tapering, once they start selling, feeding the ducks a little bit with their bond portfolio, it's going to be interesting to see what happens. So we have to watch that, okay? Because the bond market is much larger than the stock market. So many times as the bond market goes, the bond market is a good kind of disclosure, if you will, of what is to happen in future in the stock market. So the bond market is important. So we're going to keep talking about this, okay? This is really, really a big deal. But we need interest rates to rise. I think they will. I think they're really overbought right now. I'm really positioned for rates to rise here. Probably not significantly because the U.S. is going to still be meddling in this. And I don't think we're going to see any major type of interest rate spike. But what do I know? Nothing, to be quite candid with you. Moving on here, let's talk about unemployment. Unemployment is improving, not quite as fast as I think was hoped, okay? And that's where I'm going to leave that. If you look at the numbers for this week, And what's funny is they always talk initial claims, when initial claims is like the surface. That's like buying a cupcake and going, oh, wow, the cherry's so beautiful. No, the meat is inside. It's not just the top. Well, that's kind of what initial claims are. Initial claims rose. July 10th, they were 368,000. On July 17th, they were 419,000. Here's a positive, though. See, that's all that hits the news. And once again, these are the things I want to convey on really what is happening. Because if you listen to the news, you're going to hear the narrative that they want us to listen to. And most of the time, it's not the truth. It's just not, you know. I've been on my freaking stump preaching about how frustrated I am with the news and the narratives that are being spun, and with both political parties right now. Okay, I'm unaffiliated. I think it's garbage. They both piss me off. But you know what? I'm not talking about that today. So I'm going to try to stay focused here. So if you look at the unemployment claims, here's a positive number that really wasn't relayed today. If you look at total claims for unemployment that are filed, these are all programs adjusted. From last week to this week, it dropped by 1.262 million. Okay. June 26th, actually this is month over month, excuse me. June 26th, there's 13,836,648 people on unemployment benefits. That's a crap ton of people. This month was 12,573,833. That's an improvement of 1.13 million. We will take that. Actually, I lied, 1.262. But who's counting? Okay. Here's what's interesting. Pre-pandemic, you know what a normal number was? It was 3.4. We're at 12 and change. It has to come down a bunch. And as the labor economy goes, in many ways, that drives lots of things. As we know, that is starting to happen. I think the problem is, though, it's not happening quick enough, because I think they thought it was just like flipping a stinking light switch, flip, and everyone's going back to work. Well, guess what? It doesn't happen that way. There's too many people still receiving funds, okay? If you go back to June, and I talked about this, many states, they happen to be all the red states. Are the Republicans red? I don't even know. See, I don't even pay attention here. Red, blue, purple. I'm purple. Republican states decided to cease a lot of the federal additional benefits and state benefits because they wanted to encourage people to go back to work, because there were so many business owners that were saying, we don't even have enough people to hire. We've got jobs open, which there have been high job openings, and there hasn't been enough people to fill these positions. The rest of the other half of the country, these don't drop off until September 6th. Clock is ticking. Today is Friday, July 23rd. Okay. So we are getting closer to that date. So the kicker is this going to be an income cliff where incomes are falling off a cliff because people aren't working, or is it going to be a payroll catalyst? My hope is it's a payroll catalyst, but I do think there are a lot of jobs that because of the pandemic are gone forever. I think they're gone. So I think we're going to see an elevated level of unemployment, which is not what is being projected, which also then impacts inflation and impacts lots of things. Okay. Moving on to inflation here. See, I just don't have my wind. I can't, it's disgusting. I feel like a runner who hasn't ran in a while, and you start cranking it and you get tired, you know. It's okay though. Here's the kicker. Right now, you've got the government that started a couple weeks ago or a month ago saying, oh, this is transitory. What transitory inflation means is temporary. Oh, this is just a spike. It's due to the reopening. Here's why I think they're wrong. Number one, the math says they're wrong. Because when I look at the rate of change, that's a math problem. From point A to point B, how quickly, what is that rate of change? Is it accelerating at a faster rate or a slower rate? Is it decelerating at a faster rate or a slower rate? That rate of change becomes key when you're factoring in going from point to point. The U.S. government, all the economists, getting back to geometry and math class, they draw a secant and they draw a straight stinking line. Life is not a straight line. I promise that. I tell my kids that. They're sick of hearing dad saying, yeah, dad, I know. You walk to school uphill both ways in waist deep snow without shoes. And I'm like, I did. That's just how it was. You know what? It doesn't work like that. Here's what's fascinating. When you look at the CPI number, did you know that 33% of that is shelter? Shelter meaning cost of homes, cost of renting a place. Are those things going up? Okay. The quick answer on that is yes. If you look at shelter CPI year over year, we hit a low back in, it looks like February of 2021, where shelter CPI had dropped to 1.5%. Historically, it runs around 3%. Right now, we are at 2.2. It also is a lagging impactor, not indicator, impactor of CPI. Okay, so when you start looking at how the government, and Powell is starting to I'm going to say show some color in that he's starting to be a little bit concerned of going, wow, man, maybe this just isn't a flash in the pan, because I don't think it is. I think that we're going to see this shelter thing really impact, because it's really just starting to hit the CPI number. If we're at 2.2%, and historically the average is 3 to 3.5 on average, say 3.25 to split the difference, we've got like a 40% increase. How is that going to impact the CPI number? It's only going up, people, I'm telling you. So right now you have to continue to be positioned for inflation rising across the board. Okay, if you look at some other numbers, month over month home prices, if you look at it this last month, June 21st compared to June 21st of last year, up 24.4%. If you look at renters, and this goes month to month, renters have been slowly climbing, where prior to January, renters increase in price was kind of flatline. All right, we've seen some increases here as of lately, to where for last month, and this goes in May, we haven't seen the June numbers yet. May numbers were up 9.74. It's getting more expensive to rent. Another thing that's coming off is the moratorium on not being able to get thrown out because you don't pay your rent. Think if you owned a place. This is another thing, and I'm gonna bitch for a second. This is Craig's 30-second bitch session. Welcome. Grab a drink or a cocktail, and we're gonna have a bitch session. If I own some apartments and all of a sudden people don't have to pay their rent because the government says, oh, don't worry, the owners of your place can't throw you out if you don't pay your rent. People all over the country are not paying their rent. How fair is that to the person who owns the place? So what's going to happen as soon as they do start requiring people to pay rent, and all of a sudden you have rent agreements that end? I mean, my son lives in Kansas City downtown. His rent went up around 5.5% year over year when he just signed in Kansas City, and that was back in like June. Okay, it's going to start tearing up, and then you start wondering, how is that going to impact us? When you get to existing home inventories, this also adds to the prices continuing to rise. Historically, a balanced market for you real estate people. I talked to a good friend of mine, Steph, and she says on average, she was saying how we're way below average. Well, that average actual is about 6%. I'm looking at my number here. Balanced market equals 6.0. Existing home inventory, months of supply, 6 months of supply. See, this goes to prove you that this is just John Daly, grip it and rip it, Craig. And you know what? That's just the way it is. As of the last month, you know what current inventory balances were? 2.5 months, with anticipation of it remaining low. So you see, if we have low inventories and you have people competing in bidding, I mean, you're hearing stories of people getting out, putting bids $100,000 above ask price. Okay. I just sold my little house in Lawrence, Kansas, and the person that ended up getting it gave me price plus about a 5% bump, which this is Kansas of all places. So you know what? That is going to continue to happen. And when you look at how tight the supply is, knowing that when you look at CPI, 33% is shelter, that's the stickiness that I don't think they're thinking about. And that's only one piece of it. The other 2/3, I could rant on and on about other things that I think are going to remain elevated. So, moral of the story is this: inflation is most likely not transitory. So, from a positioning standpoint, we have to continue to position for inflation rising. We have to continue to position for a dollar to weaken, although the dollar's been strong. Why? I have no clue. It doesn't make sense. I do think we're going to see interest rates rise some, but I think the government right now, as long as they're buying, is going to help keep that muffled. Okay? Why? Because they just want to. So there's lots of things that we need to keep our eyes focused on, and lots of things that are really going to start to play out as we continue to move through the summer into the second half of the year. Because what the numbers are saying is we are going to get peak growth in Q2, which earnings are coming out now and they're off the charts. That's expected though. It's not like, oh my gosh, no, it's like that's what should happen. When we get into Q3 and 4, the economy is going to start to roll over and slow down. But then again, it's going to be at a much accelerated pace than what we traditionally have seen in the past. So with that, that's where I don't think we know. You know, you've got all these wonderfully smart people out there thinking that they can just connect all the dots. No, we've never been in a place like this, ever. So you know what? You can't predict what's going to happen. You can list similarities, but at the end of the day, you have to sit back and you have to let the game come to you. As a quarterback, when I played quarterback in college, as you guys know, the games when I tried to press it and make things happen, you know what I did? I threw picks. My coach would yell at me and say, Model, quit that crap out or I'm going to sit your ass on the bench. The games when I sat back and I let the game come to me, you know what happened? Good things happened. So as investors, again, at the end of the day, that's what this is. We got to become more informed. We have to become better investors. So what are we going to do right now? The page in the playbook we're playing right now is patience with a capital P. Friday, July 23rd. Great having everyone here. Great show today. I was fired up to do this. I hope everyone enjoys their weekend. And until next time, the word of the day is patience. And with that said, I am out. Thanks for joining me.